Welcome everyone to today's webinar, Learning at Lunch. This is the last webinar in our series. Today, we'll hear from Professor Richard Eckard from Melbourne University on farm emission accounting and how to build a farm or / enterprise emission profile. My name is Razak Shorka. I'm a land services officer in the sustainable agriculture team at Northwest Local Land Services. And I'm also the project manager for valuing natural assets on the farm in Northwest region. This webinar is supported by the Australian government through funding from the Natural Heritage Trust under the Climate Smart Agriculture Program. Now the acknowledgement, Local Land Services acknowledges that it stands on country which always was and always will be Aboriginal land. We acknowledge the traditional custodians of the land and waters, and we show our respect for the elders past, present, and emerging. We are committed to providing places in which Aboriginal people are included socially, culturally, and economically through thoughtful and collaborative approaches to our work. Now, a bit of a housekeeping. This webinar is being recorded and will be available on our YouTube channel for viewing later. We'll also email you the recorded version for your convenience. We encourage you to ask questions throughout the session using only the Q&A function, not the chat function on your screen. You will find the QA function at the top of your screen next to the chat function. We'll then answer these questions during the Q&A session. There will be a feedback survey before the start of the presentation. So please fill out the pre-event survey, which will show you before the start of the presentation. And there will be a post-event survey as well, which will show you after the Q&A session. We value your feedback, and this helps us to deliver the content you like to see in the future. We developed a fact sheet covering key points and links for further resources, which will be emailed to you after this webinar. So as mentioned, our today's speaker is Professor Richard Eckard. Dr. Richard is a professor of carbon farming at the University of Melbourne and science leader in the Net Zero Agriculture CRC Cooperative Research Centre. His research focuses on carbon farming and accounting towards carbon neutral agriculture and options for agriculture to respond to a changing climate. Dr. Richard developed the first greenhouse gas accounting tools for all the sectors of agriculture in Australia that now form an agreed national standard for agriculture. Dr. Richard is a science advisor to the Victorian, Australian, New Zealand, UK, and EU governments and the International Livestock Research Institute and UN Food and Agriculture Organization on climate change adaptation, mitigation, and policy development in agriculture. Thank you, Dr. Richard, for joining us today, for being available for this webinar. So I will now hand over to our speaker today, but before I do that, I will just do the pre-event polls, which I think will pop up in your screen shortly. Thank you for your time with the pre-event survey. Thank you, everyone. I will now stop sharing, and would you mind sharing your screen, Dr. Richard? Oh, thank you.
Great. So thank you, Reza. Presume you can see my screen? Great, excellent. Thanks, everyone, and thank you for the opportunity to talk to you about farm emissions accounting. This has been a long road. We developed the first carbon accounting tools in Australia probably in 2003 with the first series that we developed. And that was before anybody cared what the number was. Now it seems all the corporate agricultural companies do care what the number is. And so there's been a real focus on farm emissions accounting. So I'll just run you through the basics of why and then what, and possibly how. Now, we know environmental, social, and governance reporting is on the rise in agriculture. And I just, for the fun of it, put in a Google search of multinational sustainability reporting frameworks and came up with this horrendogram of various frameworks that are out there for agricultural reporting. Now, fortunately, while it's an absolute maze of reporting out there, they distill down to some common frameworks, which I'll deal with. Because while all these reporting do have their own branding, it comes back to the Task Force of Climate-Related Financial Disclosures and the International Financial Reporting Standards. But hopefully it'll become clear as we go through. So let's start with what's happening at the international level. Where's the drive coming from? At a country level, we've got 195 countries committed under the Paris Climate Agreement and have made nationally determined contributions. That's where we hear Australia has made a 43% commitment by 2030 and a net zero by 2050. That's under the Paris Agreement. But there's a separate global methane pledge that 160 countries have signed up to, and that includes Australia, to reduce methane by 30% by 2030. Now, before we get too excited about that, it's not focused just on livestock, it's all methane. And so about half of Australia's methane, roughly, we don't really even know, comes from the mining industry, or the fracking industry, the coal seam industry, and about half from the livestock industries. So it's not a very specific target at this stage. If you look at international financial reporting standards, especially what we call the S2 climate-related disclosure standard, we're seeing an increasing number of countries starting to sign up to these guidelines, including Australia. So I've got a list of the countries there. That's the benefit of using some of these AI tools now, where you can just ask AI to go and search which countries are involved in this, and it does a exhaustive search. Took about half an hour to come up with a list of countries in various stages of negotiation. But why do I mention this? Because these countries making these international financial reporting standards commitments affects about 100,000 to 130,000 companies that are across these countries. Now, why is this relevant to agriculture? Because when a company makes a commitment or is bound by this reporting standard, which I'll show you in a moment, it includes what we call their scope 3 emissions. I'll define clearly what scope 1 and 2 and 3 mean in a moment. But scope 3 in this context would be a multinational company like JBS, for example, is bound by the countries they operate in, and it includes their agricultural supply chain in that commitment. Let's switch from countries to companies. So there's about 130,000 multinational value chain companies that have set targets for reduced greenhouse gas emissions in their supply chain. I'll give you a short list of these in a moment. Most of these have used what we call the Science-Based Targets Initiative, which uses the Greenhouse Gas Protocol to report. And you can see a number of initiatives: Carbon Disclosure Project, SBTi, EU Sustainability Directive, California Directive. All of those have different companies that are captured within those, but at a company level, it all relates back to the Greenhouse Gas Protocol and IFRS and Science-Based Targets Initiative. Now, a while back, I put together a bit of a slide where there's about 3 pages of this kind of information you can get, where we just trawled through what were the company's science-based target initiative commitments that had been made. And so you can look at this list and come up with a rough guide that the agricultural value chain, when I talk of value chain, I include the banks in that as well. So banks, insurance, as well as processors and supply chain companies, all form the agricultural value chain. And their average commitment is about 30% by 2030, if you look across the list here, with all net zero by 2050. Now, as I said, this is just a very small subsample to give you some idea of what's out there. At a national level, we've seen Australia sign up to the International Sustainability Standards Board, especially the S2 climate-related disclosures. And there have been 2 consultation papers around the climate-related financial disclosure, one in December, one in June, public comment, which then resulted in the Treasury Laws Amendment Bill of 2024, where Australia's Sustainability Reporting Standard was approved, which relates to climate-related financial disclosures. More specifically, if you look at the Treasury Laws Amendment Act, I've given you the actual name at the bottom of the slide. If you want the link, you just type that into Google and search for these 2 policy documents. But why it's important is because it includes Scope 3 from 2027, which means all agricultural supply chains are included. I'll show you the timelines in a moment. Now, when this Treasury Laws Act was passed, I happened to meet with the minister at the time and sort of had a meeting to say, it's fine to pass mandatory climate-related disclosures, but you can't have the private sector dictate what the method is. Otherwise, you end up in chaos. You can't have the big 4 financial accounting firms determine the tax methodology. Government has to do that. And so the minister then commissioned this process of developing a guideline at a national level to say, if you are going to report under this Treasury Laws Amendment Act, this is the methodology that should be used. We're seeing this happen in Canada, in the UK, in New Zealand, where government is taking the responsibility for what's the method. Now, this is quite relevant because I developed the greenhouse gas accounting tools quite a long time ago, before anybody cared about what the method was. But we were able to inform the process of developing these voluntary emissions reporting guidelines. Now, the first tranche of those is out for public comment. So anyone who's interested on this call, tranche 1 is out there for public comment, I think closing by the 19th of December if you want to comment on them. But this is the timeline. So as of the 1st of January 2025, the bigger companies have already been captured into reporting. But by 2027, every supply chain company with 50 million or more revenue or 100 or more employees will be reporting. And that includes their Scope 3, which means most of agriculture will be captured by this, because most of our value chain companies will be required to report on behalf of their farm supply. How this works initially is something we can talk about in the quick Q&A time. We're working with some of the larger companies on how they do it, with not every farm will have a greenhouse gas audit by the 1st of July 2027. Can they report a sample of an average, a normal distribution of the emissions from their supply chain? So if you read the Act, initially there'll be some leniency until we actually get the methodology right. So in summary, who's asking? Well, companies are asking through multinational supply chains making commitments. Multinational central banks and insurers are making commitments through the Net Zero Banking Alliance and other S2 climate-related disclosures. And you've got companies that have made pledges and mandatory reporting. So it's here and it's with us. We have to respond to it. So how do we do this? What are the rules of the game? What's the right greenhouse gas number? And that's why we have started with this voluntary greenhouse estimation and reporting guidelines that are out for public comment at the moment. International standards are already in place through the Intergovernmental Panel on Climate Change, for example, and the Greenhouse Gas Protocol is more taking that and saying, well, how do you put it together at an entity level? So the Greenhouse Gas IPCC is sort of for country level reporting. Greenhouse Gas Protocol is more for company level reporting because they are not the same framework. But Agriculture Victoria came up with this very neat infographic that I thought was worth sharing, where what makes up a farm greenhouse gas account. So we start second from the left with enteric methane or methane from manure. All sources of methane have to be added on an annual time step. All sources of nitrous oxide have to be added, where they come from fertilizer, urine, dung, crop residues, and any CO2, like for example, when you put calcium carbonate, which is agricultural lime, you put it on soils, what's released is the CO2 that was a fossil CO2 that had been captured in that rock for millennia. But then the annual change in soil and trees can be deducted from the total to form a net balance. That will give you a net carbon account that accounts for what we call the scope 1 and 2. Again, I'll define that in a moment. But if you want to know what the emissions are per unit of product produced, which is on the right-hand side, the net annual footprint, you have to add in the indirect emissions as a result of what the farm bought. In other words, in order to produce the product, the farm has to bring in urea fertilizer or has to buy in steers or has to buy in glyphosate. And so the embedded emissions in that product have to be accounted because they're essential to producing the right-hand side, which is the product that comes out of the farm. Now, what are the principles? Before I sort of go into what scope 1, 2, and 3 are, is just the farm account. And this is when you're looking for a tool to do a farm account. These are the questions you'll be asking. It must be consistent with the Australian approved greenhouse gas inventory method. In other words, you can't go and pick the Brazilian method or the Argentinian method or the New Zealand method if it gives you a nicer number. You have to stick with the IPCC approved method for Australia. But this is a top-down methodology. It works for the whole of New South Wales, for example. And so what we've had to do is say, well, let's adjust it to a bottom-up rather than top-down. A simple example is it works on what percentage of the New South Wales land area gets enough rainfall to leach, yes or no. And so 43% of New South Wales land, agricultural land, gets more than 600 millimeters of rainfall, apparently. That's not a question you ask when you do a farm audit. When you use a farm audit, you say, is my farm getting more than 600 millimeters, yes or no? So it's not a 0.43 of New South Wales, it's yes or no, if that you can understand that. But it must be aligned with international reporting standards because now we've got companies like Frontiera, Wilmar Sugar, we've got JBS, Greenhams, all required to report internationally using a guidance document from the Science Based Targets Initiative for land and agriculture, which largely adheres to the Greenhouse Gas Protocol. Now, that's not inconsistent with the first statement because the actual emission factors you use are still consistent with the Australian inventory. So, but we've just had to put it in a format that is required by your value chain when you're a farmer. But it also has to account for everything from before the farm through to the farm gate. We stop at the farm gate because farmers can't take responsibility for what happens downstream of the farm when the transport company picks up the livestock or the abattoir's emissions are not under the farmer's control. So we stop where the farmer stops control. The farmer can choose what to buy into the farm and can choose what to sell out of the gate, but beyond that, probably not. So we use this pre-farm to farm gate framework to draw the boundary around the analysis. It also has to be reported on an annualized basis. And the first question people ask is, well, steers take 18 months to get to market, or sugarcane takes 18 months to get to market. So we annualize, and ideally, and what we've recommended in the national standards, we iron out the variability by reporting on a 5-yearly mean or a full crop rotation cycle or a full livestock cycle. In other words, you're going to get a lumpy report if you report strictly on an annual basis without taking a rolling mean. That's still debatable as to whether that will come through in the guidelines, but that makes more sense to deal with the variability that we have in our agricultural supply chain. Then we have to report it in a scope 1, 2, and 3 format, including carbon sequestration. So what do we mean by scope 1, 2, and 3? I thought I'd just step back and explain this, because this is common terminology, but a lot of people have the wrong idea of what it means. There's two slides here. One that's about what it means when you're a farm, and then the second slide is what does it mean when you're a bank or a processor. So from a farm's point of view, a scope 1 are the direct emissions. That's the emissions from your cows, from your sheep, the emissions from fertilizer that you put on the paddock, the emissions from diesel that you use on the farm. Scope 2 is indirect emissions that occur in the Hunter Valley as a result of you consuming electricity out of the grid. So that the emission didn't occur on your farm, it occurred in the Hunter Valley, but it occurred because you consumed on the farm and could have gone for solar energy or renewable energy. So that comes in, usually pretty small. But scope 3 is the one that a lot of people don't understand. Scope 3 are indirect emissions that occur before or after your farm, but as a result of consumption on the farm. This is like when you buy urea fertilizer to spread onto your crops. That urea takes a lot of fossil fuel energy to manufacture that urea, and it might be manufactured in China, in Yemen, or in the Middle East, or in Canada. And depending where you get it from, if you get it from China, it has a bigger emission footprint than if you buy it from Canada. So we're starting to see companies making choices about where they buy. If you're in Western Australia, CSBP preferentially buys from Canada because it's reduced their carbon footprint. That made a 15% difference to a carbon audit on a grain farm in Western Australia, just because the fertilizer company is now taking this seriously and saying, can we buy a lower emissions footprint before it arrived in Australia? Glyphosate, the same thing. If you're buying replacement animals or you're buying speculative steers into your operation, you have to take into account the emissions that they incurred before they arrived on your property, because that's part of the emissions footprint of your property. So that's what scope 3 is. Now, it seems unfair, but what starts happening with scope 3, and the example of CSBP is relevant here, because what we see is initially the scope 3 is what it is. But next year, when you go and buy your fertilizer, you say to your fertilizer company, can you drop the emissions of the product you're selling me so that I can drop my emissions on farm? Or you go to your glyphosate supplier and say, can you sell me carbon neutral glyphosate? Or you change where you buy your steers from to buy from a carbon neutral producer rather than a high emissions producer. Now, important to understand whose scope 3 is scope 3, because now let's switch positions. We're not the farm anymore. We now are the bank or the value chain. So we're JBS or we Rabobank. Scope 1 is your direct emissions, same as the farm, but except your direct emissions as a company is the diesel you use to drive up the farmer's driveway. So not a big emission source. Your scope 2 is the same as the farm. It's the electricity you run the air conditioner in the building in downtown Sydney. Not a big emission. If you're the bank or the supply chain, your scope 3 is all those farm emissions, because you're a value adding company in the value chain. You lend money to those farms. So their emissions are part of your scope 3 of your lending portfolio. Their scope 3 emissions are part of Greenham's inherited emissions scope 3 when they make commitments on reducing emissions. So scope 3 for a value chain company is quite material. It's their biggest emission, because scope 1 and 2 are very small if you just run a business with an office in downtown Sydney. But if you're buying meat from 1,000 producers, all those emissions add up to a very big number. And when they set that list of targets I showed you earlier, they were talking about scope 3 targets. So when Rabobank has a scope 3 target, or National Australia Bank, or JBS, or Greenham's, or GrainCorp, they are talking about your farm's emissions that they have to report on. That's why it's become so important. Now, what tools are available? Well, we developed these greenhouse accounting framework tools that cover a number of industries. What has happened since then is other tools have started ingesting these Excel spreadsheets. So we just produced them as fairly simple, open, transparent, unlocked spreadsheets that weren't a black box. So you could go and see how we developed the method. What are we accounting for? Where does the reference come from for where we got the calculation from? So you can clearly see we're not making up new information. We're not making up stories. So wherever in the greenhouse accounting framework spreadsheets we have a calculation, on the right-hand side of that calculation, you can see we referenced a particular equation in the greenhouse gas inventory, or we've referenced a scope 3 emission factor from the EcoInvent database. So very transparent. But there's obviously a business model to build these into commercial software, like the environmental accounting platform, was run by Agriculture Innovation Australia. Now, they've received a fairly substantial grant from the federal government to ingest these greenhouse accounting framework tools into what we call an API. An API is an application programming interface where it's a black box sitting on a server that you can send information to and get information back from. So if you've got your own farm software and it can send the right information out, it will get your greenhouse gas audit and send it straight back. So you don't have to learn a new tool. You can just program your existing farm software to send the results and get the results back. That's the ideal way to deal with it in future. There are other tools like Ruminati that have got a very good user experience. They are consistent with the greenhouse accounting framework tools. And the MLA carbon calculator, dairy based, there's an eggs calculator, there's a wine calculator, all based on the greenhouse accounting framework. There are other tools like CSIRO has produced a tool called FarmPrint that is aimed mainly at the grains industry, the cropping industry. Again, it is identical to the greenhouse accounting framework. We've compared the two tools to make sure there's not a different solution. And the Cool Farm tool, which used to have an international methodology, but now has an Australian compliant methodology. Those are the main ones that I'm aware of. When it comes to carbon stocks and fluxes, you've got to realize this is a different equation. So when you're doing the former, so when you're doing greenhouse gas emissions, we ask how many animals, how much methane they produce. We ask how much nitrogen fertilizer went on, how much emission came from the fertilizer. That can be done fairly simply on an annual basis. When it comes to carbon in soils and trees, it's a different question altogether because you need to know where you came from to know where you are, to know where you're going. In other words, what did you do 20 years ago? Did you clear the land? Did you plow it 20 years ago? Did you put it in permanent pasture 20 years ago? Well, 20 years later under permanent pasture, you might be at capacity of what you can build in soil carbon. Whereas if you were cultivating the soil for 20 years leading up to today, and now you put it into permanent pasture, well, you've got a very low carbon, but you've got great potential to increase. So this is a different type of analysis, and it does require either a model or direct measurement. So the tools available for soil carbon, you could either use the Australian Carbon Credit Unit Scheme measurement method, which says there's a protocol for how to take soil samples to measure the stock of carbon. Now, probably take a step back and talk about stocks versus fluxes, because you can have a total amount of carbon in your soil, but that doesn't tell you how much it increased by. You can't claim all the carbon in your soil. You can only claim the degree by which it changed in a period of time. So you'd have to do a direct measurement of a baseline at time zero, and then 5 years later come and take another measurement or another modeling approach. And so that gives you the flux. In other words, how much did it change? Did it go up? Did it go down as a result? So you can't just take one measure of carbon stocks. You've got to take two measures at two different time periods, and the difference between the two is the flux. Now, there's simple models like the Socrates model, which is linked on our website. That's a very simple model. Within about 10 minutes, you can get a rough estimate, or you can go to the Australian government's FullCam methodology, which is on the right here, which is based on the Rothamsted carbon model to get your soil carbon. Vegetation carbon, you can either do direct measurement. Within the GAF tools, the Greenhouse Accounting Framework tools, we have created 400 lookup tables. So you can say, I'm in New South Wales, I'm in this region, and I've done environmental plantings, and it's 20 hectares, and it's 20 years old, and it'll tell you roughly what the carbon sequestration would be. These are all derived from running multiple instances of the full CAM model. But if you want the definitive answer according to the government, you would have to run the full CAM model, which is based on the forestry model called 3PG, which is an alternative. So in summary, farm emissions reporting is pretty much a reality now. Initially, I mentioned that industry averages might suffice for the first few years while we settle in an adjustment period. And so it might be that the bank is willing to sort of just say, well, the average livestock producer in Western New South Wales is a 15, so let's multiply 15 times the number of stock on hand. That's our report. But that won't cut it after the first 5 years. Just remember, when you're talking to farmers, a farm greenhouse gas report can be a very useful indicator of overall farm efficiency. If you take it through to emissions intensity, where you said total greenhouse gas emissions divided by the primary product produced. So emissions per ton of live weight is a very good indicator of how efficient is your breeding program, because if you're a 17, probably means you've got about 50% weaning. If you're a 12, it probably means you've got about 85% weaning. So a very different efficiency, and it highlights the inefficiencies. But just to give you an indication of the further research that we'll be doing under the CRC is looking at how do we automate this process for farmers? Can we come up with proxies or surrogates, or can we work back from supply chain data to estimate what the greenhouse gas footprint would be? Because we don't want to impose a new onerous reporting on farmers if we can avoid it through using existing information that is out there or automating that information. So, Razak, I'll stop there, and there's links to where these greenhouse accounting framework tools are, and I encourage you to look at what the CRC is doing in their research program. Thank you.
Yeah, thank you, Professor. Thank you for presenting today. So we have this link in our fact sheet. So you will get this link so that you can explore on your time. So I will now open the Q&A session. So if you have any question, or if you'd like to speak, or maybe we can unmute you, just put your hands up. Yep. So yeah, I will start with the question because this is a very new to me actually, and we are trying to give the landholder we are working with more understanding about the carbon emission and stuff like that. So can you tell me, Professor, what is the link between maintaining a carbon emission profile, and is there any link between there will be an improvement of farm productivity in the long time?
Yeah, look, when we say most of the value chain companies targets, the value chain company targets that I showed, most of those targets are emissions intensity, and that makes sense because if you're a government, say you're the New South Wales government, you're concerned about greenhouse gas emissions from New South Wales. So that's an absolute result. If you're JBS, you're concerned about how much meat you buy and what's the emissions associated with that meat. So straight away it becomes an emissions intensity target, because that's the only thing they can control is how much meat they buy that has a 17 footprint or a 15 footprint or a 12 footprint.
Yeah.
Obviously, to meet their target, they want everything 12. Now, the reason why I went into that explanation is because you then have to ask, well, what does the greenhouse emissions intensity mean? Well, the 12 is just a much more efficient farmer. The 12 would be making more money than the 17 because the 12 has got 80% weaning and the 17 has got 60% weaning. So straight away, it's a more efficient farm. So there's a direct link between emissions intensity and profitability or productivity. So I think it's an important message to get out to farmers that if you want to meet supply chain demands in the future, Getting your greenhouse gas account is just a way of telling how efficient your farm is relative to the average of the district and where you need to work on. So what we can see in the future is, I'm using the sort of 17, 15, 12 as an indicator, but that's 15 tons of emission per ton of live weight from a livestock producer in Western New South Wales, for example.
Yeah.
If you're a 15, you're an average. If you're a 12, you want to be rewarded for being better than the average. And there's certainly mechanisms coming about to do that, where you'll be a preferred supplier because you're a 12 and you're helping JBS meet its 30% target. If
Yeah.
you're a 17, you'd need to please explain why you're not a 15.
Yeah.
And there would be assistance to move from 17 to 15.
Yep. No, thank you for explaining that. We got some other question from the attendees. So I'll go with the first one from Janine Pavel. She asked, in the GAF, does the calculation consider the fertilizer placement method, i.e. drilled versus sprayed?
Janine, a very important question that no, at this stage, it's very blunt. And it's something we've raised. I sit on a number of committees advising the government on how to turn a top-down inventory calculation into a bottom-up relevant result. Because right now, the way the calculation works, you could dump all the fertilizer for the whole year in the corner of the paddock, and it would get the same emission factors if you put it out very judiciously and very efficiently. So we won the argument for certain sectors where we've got enough data. So in the next few months, you'll see high rainfall grains, for example, getting a more rate responsive methodology coming through. So this is a work in progress, and at the moment, it's very blunt.
Yep. Thank you, Professor Hope. Okay. Yeah, maybe we'll just allow Mike. Can you try unmute yourself, Janine, so that you can speak? Okay. I'm not sure if that is working.
Can you hear me now?
Yep, we can hear you now.
Excellent. Thanks for that answer, Richard. I guess what I was going to comment was, I appreciate that the tool will keep getting tweaked and improved as we go along, but I guess it's important. It'll be important that the tool reflects practices on farm. Otherwise, it's pretty challenging for an industry to encourage these, I guess, lower emitting practices if the calculator doesn't account for them.
Yeah, important, Janine. We have started developing some of these calculators. We've got a prototype that we've just developed a few weeks ago to recognize coated fertilizers, for example. So if it's agrotane or DMPP coated nitrification inhibitor and urease inhibitor coated fertilizers. So that's a step forward where there's 50% less nitrous oxide from fertilizer if you have a coated fertilizer. That's the assumption behind the tool. Most of the problems we've got is we just don't have the data to justify the calculations because this is such a new emerging area. It's probably policy moving ahead of research or research investment at this stage.
Thank you, Janine. We got a few more questions actually. So I got a question from Amanda. So who actually asked many several questions. So I'll go with the first one. So what do the majority of livestock producers do with no solution for methane and no ability to sequester carbon on the specific landscape?
Yeah, look, Amanda, they're very important. That's why I made the sort of strong point around emissions intensity, because there is always a solution for a livestock producer. So if you're let me use JBS as an example of a meat buyer. If you're JBS and you've got a 30% target and the average is a 15, all you need to do is buy the 12s and you've almost met your target. So that doesn't so if your livestock producer was an early mover and was already a 12, there's no disadvantage to them being a 12. They're going to be at the head of the queue. If they're a 17, well, there's lots they can do to become a 15 or a 12. So let's split your question into absolute reductions, which is a different story, versus the emissions intensity, which is what the supply chain are interested in. The supply chain will always be interested in buying from efficient farmers if they are under pressure. And so there will always be a case of, if you're a 17, you can become a 15 and become a 12. That's just adoption of best practice. And so when you talk about will the market be shutting down the majority, what might happen is by default, the less efficient farmers that can't improve their efficiency might be less preferred suppliers, or be given strong incentives to become more efficient, which is no different to what LLS has been trying to communicate to farmers for the last 40 years. If you look at the measures to improve emissions intensity, they are all things that come out of best practice manuals for the last 40 years. If it's absolute reductions, that's a different story, but there's no imperative right now for that to happen until we get the supply chain engaged in a reward system, which just behind the scenes we are working on at the moment. So hopefully that answers the question. There won't be any shutting down. There might be some redirect. And one of the concerns I've got is that carbon markets could eventually skew the land in such a way that the less efficient farmer finds it easier to plant trees and get out of agriculture. That's not the intention of carbon farming, as far as I'm concerned.
Yeah. I think you already answered the second question, so I'll go with the third question that Amanda asked. What modeling has been done to ensure the GAF output creates incentives for genuine emissions reductions rather than de-incentivizing investment or leading producers to exit certain land types altogether?
Is that written on the list there? I was just looking.
Yeah, it's on the chat. So if you go to the chat, you can see that. Very
what
question.
modeling has been done? Yeah, okay. So
Yeah.
we've done extensive modeling of case studies across the whole country, and certainly come up with options for producers to respond. So if you're looking for case studies, there are emerging set, probably more focused on the livestock industries, leading to at this stage we wouldn't be saying any of them would be exiting the industry. That's a different question altogether. But there's a lot of case studies available right now on what emissions options are available in different industries. So Razak, I could probably circulate something coming out of the CRC that summarizes all those options.
Yeah, like if you can send me those things, I can put them in the fact sheet. So yeah, so Amanda can have a look. And so we'll take the questions from Bruce. I'm going to, sorry Bruce for keeping you wait for a long time. So I will just, can you try if you can unmute yourself now?
How's that?
Yep,
Can you hear
can
me?
hear you now. Thank you. Sorry if I
Thanks.
covered the wait.
Thank you. Thanks, Richard. Yeah, just probably an observation. We've been involved in doing this for a few years. I gather you pointed to that further research to assist farmers better. The emissions side seems to be covered fairly well. It's the sequestration side. I'm just conscious some of the tools that are mentioned there I don't really find them farmer or user friendly as your GAF tools. Are you looking to to insert some of those calculations for vegetation and carbon into the GAF tools, or is that an area you're working on?
Yeah, thanks, Bruce. Yeah, we are. We kind of, if you're familiar with the GAF tools, there's those over 400 sort of 100-year sigmoidal growth curves that we got out of running multiple instances of FullCam, and that's how we got the lookup tables. Some bright user went through them and actually pointed out to me that statistically there's only 4 growth curve patterns in the whole database. So that got us going, thinking actually we could reverse engineer FullCam to come up with a 5-question version of FullCam, which is what we've done. So the idea is that in the next version of the GAF tools, we might have a version that doesn't go through the whole sort of exhaustive FullCam analysis, but actually just applies 4 different logarithmic curves that have the M layer capping it, if you're familiar with the terminology. So it's a little bit why I put the Socrates model in there as well, because that's the same thing, where we've said, well, there's a complex approach to doing it, which is FullCam, but you almost need a PhD to sort of run the show. But here's a 5-question model that'll get you 80% of the answer. And in many cases, 80% of the answer is good enough with the uncertainty you've got of trying to run a FullCam analysis yourself. So hopefully that's a big step forward, where, people keep telling us don't make the GAF tools more complex, but they also want carbon sequestration, which is a complex question. So how can you do it in 5 questions? And that's the challenge we've taken on.
Yep. Thank you, Richard. So we got another question from Andrew Jack. So if you go to the Q&A function on the top, so you can see that. So when will the larger meat suppliers start to ramp up pressure on growers to supply their emissions intensity, considering that market demand is outweighing market supply?
Yeah, look, you've just highlighted there's a fair internal conflict if you talk to the big suppliers like JBS, and they're very well aware that supply and demand is actually probably the big issue for them, but they're also under pressure to deliver against their stated commitments. And there are some greenwashing lawsuits going around the world at the moment that these companies are very aware of. So a lot of them are exploring that. That's why I mentioned the sort of, if you can imagine how they might approach it initially, they wouldn't be asking every single supplier to give them a greenhouse gas audit. But what initially for the first sort of 5 years, what we might see is they conduct a survey, like we've done for one of the major banks, a survey of 100 graziers in Western Queensland. And that's where we came up with this normal distribution that says the 5th percentile is a 12, the 50th percentile is a 15, and the 95th percentile is a 17. Therefore, hand on our heart, we statistically can report that 15 is the average number of our supply chain and our exposure in that region. That is an example of where some of the banks are thinking. And I would bet the larger meat suppliers would be going down the same route initially, saying, can we do it on a statistically valid survey basis to get an idea of what our exposure is, and initially based our reports on that. I could almost guarantee by 2030 that won't cut it anymore, and that they'll be requiring bottom-up reporting. But initially, there's this nervousness where you don't want to disenfranchise your farmers because you still want their supply, but you also have a global imperative to report it against to your shareholders. So a lot of them are just in a very delicate balance at the moment, Andrew.
Yep. Thank you, Richard. So we got another question from Ashley Silva. So in your work with JBS and Big Food, do you see a world where they would be willing to provide the same level of financial incentive for farmers by paying them to address their emissions at the level to which safeguard mechanism companies are planning to spend on ACCUs for carbon farming under the Australian government carbon market?
Yeah, so actually a really relevant question, and you'd probably, I don't know if you've heard, but I've sort of really been pushing this thing called insetting, not offsetting. And what you presented is the exact argument we've raised, where if you've got Australian carbon credit units and you can sell them to the mine industry, well, there's cash income you could be getting for your farm. So that's the counterfactual, which actually says, which got us to the point of going back to the value chain, saying, if you want to bank the emission reductions from your pastoral companies, for example, you've got to be giving them a value proposition equal to $35 a tonne for their carbon. And so that's spawned the whole insetting dialogue, which says, well, if you're JBS and Rabobank, the worst thing that can happen is your farmers keep selling carbon credits to the mining industry. Because when the day they set the target, they implied that somehow the farmer would socialize or share their carbon number along the supply chain and help them meet their target rather than sell to the mining industry. Now, what none of them have done is realize actually the bank's target, the advisory company's target, the fertilizer industry target, that 30% they've all got is the same 30% on the same farms. It's a shared target. So what we've done through the Sustainable Ag Initiative platform is got them to start talking. In other words, we've got a dialogue going in the red meat industry and the cotton industry, a dialogue going in the dairy industry, grains industry, saying, let's all sit around the table and work out what this business model looks like, because it's not up to the meat company to pay 100% of that $35 a ton counterfactual. So the whole insetting argument is starting to get some steam now, where if you do the calculation on the red meat supply chain, it'll probably only cost JBS less than the monthly or the seasonal deviation in prices to incentivize action on farm. So a really good question, because once they all sit around the dialogue table and create this virtual supply shed, we call it. If you look up SustainCert, you'll see the definition of a supply shed. It's a way of getting farmers within a collective, within a certain product category, to all come together with their value chain and share in the pain of how we're going to achieve these targets. And we can see a business model emerging out of that will incentivize the farmers against selling the safeguard credits to the mining industry, for example. Because you can imagine the moment while that's happening, that would be the worst outcome for JBS to ever achieve a target if the farmer's not sharing with them. If anyone wants, I've got a whole presentation on the supply shed concept and insetting as a mechanism that I can share.
So I think we're running out of time for today. So yep, I think that would be our next sort of webinar, maybe workshop, so we can explore in future. And I got another question from Janine Powell. Will remote farms be at a disadvantage? For example, are transport emissions reported for inputs and on products are produced?
Yeah, thanks, Janine. Technically not, because we take it to the farm gate. Now, straight away, you can sort of say, well, some of the big corporate farming operations are growing cattle in Northern Australia, backgrounding them, breeding in the north, growing them in the Channel Country, bringing them down to a feedlot. And so if you put the boundary around the feedlot and the grower property, you probably would have to be counting the transport emissions in the middle. Having said that, if you're a family farm and you're just selling to the abattoir, you go to the farm gate. When you look at the GAF tools and how much that transport accounts for, it's much less than 5%. So actually, the transport from a remote location versus the sort of more proximal location isn't a major component of the greenhouse gas emissions of the farm. So whichever way you look at it, whether you're a corporate that has to internalize it within your value chain, or you're a family farm that doesn't have to internalize it, the difference is not that great.
Yep. Thank you, Richard. So we got a maybe follow-up question from Amanda. So I think this is the last question we'll try to address. We'll address regarding the response about intensity rather than reduction. There are biophysical aspects of properties that cannot be changed by best practice management. For example, remote properties with poor soils or high inputs. In the GAF tool, these create a high number that is prohibitive when factoring in Scope 3 emissions. I think it's more about a comment, I guess.
Yeah, no, it's a complex question, Amanda. And you could actually argue that if you're a beef producer in northwest Tasmania, you're going to be a 12 almost immediately. And if you're an extensive grazier from Western Queensland, Channel Country, you're probably going to be a 15 automatically, just because it's more challenging to get 90% weaning. It's easier to get 90% weaning in Tasmania than it is to get it in the Channel Country. So we can see the need for companies to stratify, because you can't just disadvantage all rangeland systems. Having said that, rangeland systems tend to have no Scope 3 emissions because they don't buy fertilizer, they don't buy chemicals. They tend to be breeder operations that sort their own progeny out, and they don't have Scope 2 emissions from electricity because they tend to use renewable energy now. So actually, the difference between a Northwest Tasmanian farm and a Queensland outback farm just comes down to weaning rate and mortality rate, actually, which is not impossible to achieve at the same scale. So a complex question. There'll need to be some stratification of that, so you're not disadvantaging the sort of natural asset we've got in rangeland systems, just because they cannot be more efficient.
Thank you, Richard. So we tried to address most of the question today because of the time limitations. So yeah, so we'll go to the post-event survey. Thank you, Richard, for addressing all the questions. I hope so the attendees has got the answer. So I will just bring up the poll.
So for everyone, there's a link in the chat if Dropbox works for you.
Yeah, okay, yep.
That was the presentation I did at the Southern Australian Livestock Research Council conference.
Oh,
And
awesome. Yep.
if you just want the insetting part, start at 32 minutes.
Yep, okay. Oh, that would be awesome. So I will share this link to the attendees after this. Yep. Thank you, Richard, for sharing that. We'll just give 1 or 2 minutes to people to respond to the polls. So far we got 3 responses. Thank you everyone for completing the survey for us. That's really helpful. Yep. Thank you everyone who responded to the polls. I really appreciate your time. So, and I would like to again thank you for joining us today. And if you'd like to know more about our project valuing natural assets on farm, feel free to contact me or reach out to our local land services office. If you would like to know more about natural capital or need support managing natural capital on your farm, please contact Andrew Jack, who is our natural capital advisor for Northwest Local Land Services. Thank you everyone again, and so I will send the fact sheet after this one, and and we recorded this version, so I will send the link once it is ready. Thank you again, Richard. I really appreciate the time today, and thank you everyone for joining us today. Thank you.
Thanks, everyone. Thanks,
Thank you.
Ryan. Cheers.